Higher mortgage rates, the new normal. Trump takes office. What's that gonna really do? So what does the home buyer do in 2025? We're gonna find out. Oh yeah. Hey, it's Huddy. I've been doing this mortgage type stuff since 1999. To save you some math, I'm old. Getting right into what we're talking about today, mortgage rates today and going into the rest of 2025, how Trump's policies are going to affect that, and the new normal of these higher interest rates. What does that really do in terms of buying that home? We're going to cover all this, and I'm going to rip the Band-Aid off right away. So like I said, I've been doing this a long time, and I talk to so many people, and so many people want to wait for interest rates to come down. Totally get it. Makes sense. We could go on and argue pros and cons for that. That's a completely different video. What I'm going to do now is pop up a graph here, and you're going to see MBA, which is the Mortgage Bankers Association, Freddie Mac, and Wells Fargo. It's kind of the big three when we're talking about rate prediction, and you need to understand this is for the entire year. So looking at the chart, you can see that 6.5% looks pretty good in quarter four. At the time of this video, we're in quarter one, and we're floating around 7% right now. So waiting for that 0.5% could cost you on the home that you want, because we don't really think rates, we're not going to see fives, right? It's not a thing. And it's unfortunate, but what a lot of people mix up, and we're going to get through this really quick, is when the Fed cuts rate, people are assuming that has to be the mortgage rate or it has to affect it. Well, yes and no. I mean, we had several cuts this last year, and the mortgage rate still around 7%. It's been higher, it's been a little bit lower, because that's just it. We are traded every single day. And I shouldn't say we, it's not like me and the turd in my pocket, and it's not Dirty Mike and the boys either, but it's bonds and treasuries. That's the mortgage rate. And that's affected by several different factors, but you could kind of break them down into economic policy, investor confidence, that's another one, and the economy, what's cooking there. It's not necessarily what a president does, but it's his policies. He can't directly affect it. Inflation is another factor that we look at, and it affects mortgage bonds being the key word, long-term debt. So what do we do with these interest rates, and what can we expect? What does that really do for affordability when we're trying to buy a home in 2025 and in 2026? Because these rates aren't going to magically go from 6.5 to 5, because the clock turns from 2025 to 26. It doesn't work that way. So what can we do now to be looking at these homes? Well, the first kind of thing that you should realize is that there's many people sitting on the bench waiting for these rates to come down. So it does a couple things for our home buyer. Better negotiation terms, because there's less competition for that house. And even still, with that being said, there's still kind of a shortage in real estate, in homes for sale. Part of that is because of the higher interest rates. Take me, for example. I'm at 3%. Do you think I want to sell my house and give up 3% to buy something else to get 7%? No. So there's a lot of us sitting here saying, I'm old, I got 3% or 2.5%. I'm going to wait myself, right? Unless they have to move. So because there's less properties, there's still people wanting to buy. There's a little bit more competition, but not like when rates are low. So let's talk about these interest rates too while we're on it, and the history of them. Real quick, understand the average mortgage rate, it's about 7%. I didn't go Google it or look up do any math, because it's been over 50 years. We've had two exceptions where this gets a little bit crazy. The 80s, yeah, they were in the teens. I'm talking about interest rates in the teens. I think the peak was like 17 or 18% to buy a house. So if you're complaining about 7, yeah, getting the Wayback Machine, right? But then when you look at the pandemic, which we just came out of, and we saw interest rates 3%, 2.75, 2.5. Some of the rates that people were getting were insane, and I'm one of them. So take out those two exceptions, we're usually clipping around 7%. Heck, I remember when the market crashed and we were freaking out because we were getting these awesome rates in the 4s. So even when the bubble burst, if you're not old enough, that was a big deal. It was a really big deal. A lot of loan officers, realtors, blah, 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 lost their jobs. It was a mess, right? I could go on and on about those days. But just understand that getting a rate in the 6s is kind of normal. That's kind of average. So what we want to talk about is how can we budget knowing that home prices are still going up, which they are. So you're going to be paying a little bit more. And when you're thinking about it, when should I buy a house? What are tricks I can use to maybe get in? Well, you could look maybe a little bit more rural, more outside the city that you were thinking about, especially if you don't have kids yet and schools aren't as important. That's one option. You could be looking at what's called a 1.0 or a 2.1 buy down to help out your interest rate. Basically what that means is you can pay to have a lower interest rate for a year or 2 years, and then it will go back to, like, say you got 6.5, year 1 it would be 4.5, year 2 5.5, then it would go to the 6.5 for the life of the loan. The idea being that maybe if rates come down, you could refinance. If not, you enjoyed a lower interest rate for the first 2 years or 1 year. A couple options there. Another thing that we want to maybe look at is kind of reworking your expectations for what your money will buy. Oftentimes we get in this champagne lifestyle, beer budget type of situation. Because maybe you rent actually a really nice place. Maybe you got a good deal. So maybe it's not right to buy. But I think you're getting the idea, right? Changing your expectations and understanding that this first house, you're only going to be in it for 5 years anyway. I mean, I swear to God, that's what we talk about out there all the time. That first house, it's not your forever house. You might argue with us, but the stats don't lie. You move. But knowing that, that gets you into that first house. So maybe you don't need to try to spend as much money. You really do look for that home that you got to put a little work into. You can also look at refinancing some debt. If you bought a car, like say in the last couple of years, we saw rates much higher for those interest rates. Maybe you can refinance and you can pull that payment down or work harder on paying off a car loan. Just different things like that, instead of like, I have to make more money, or complaining about it that rates are just too high. Maybe there's a different way to restructure your debt because those rates did come down, and it might save you a few $100 a month. Looking at your budget, getting out those bank statements at least 3 months worth, taking a look, what are you really spending your money on? Because most people I know, they don't really look at that. They look at their balance, think, what do I got coming out? And they're kind of good with it. I got money. I can go buy that latte at Starbucks or whatever. You get the idea. So we want to look at some of those things and really dial in. People want to buy a house, and we always want to say it's, when I'm financially responsible. Well, I mean, kind of bullshit, really. I mean, did we have a kid when we were financially responsible? I know I didn't, that's for sure. But as you're growing older or getting older and you're having kids, you're paying rent. You figure that out. You can figure out how to buy a house and pay a mortgage. We just got to get you on a plan. That's really about it. You know what nobody tells you? They don't tell you, hey, dummy, you buy your house, yeah, you have 7%, but if it gets to 6 or 5.5, whatever your magic number is, you refinance. That's what you do. Or you sell, take your equity, and buy the new bigger house at 5.5%, and your payment doesn't even change. People gotta know this stuff. The end. What are you still doing here? Watch the next one.